Can we reimagine the systems we live in? How can economics reflect our common humanity? And can we change it in time?
Welcome back to Real Time with Steve and friends. This week we've got Ed Peters. Donald Trump won the election. It's going to be a whole lot of fun in America now. Enjoy the next 4 years. Be kind, stay safe, and enjoy the show.
What now? Let me tell you what now.
What now, indeed. Indulge me in a bit of recent experience. I was holidaying in the States in South Carolina in August on the coast. Traditional Republican state, massive cars, even bigger meal portions, world-class hurricanes, the whole deal. On the surface, everything looked like it was thriving. Jeffrey was our Uber driver to Savannah Airport. We got chatting about work and life in general. Things got past the usual small talk. He's a proud granddad in his late 50s with more than a few interesting life stories. Practical, no-nonsense guy. Reminded me of my Kiwi uncles growing up. What struck me was his concern, not for himself so much, but for so many around him who seemed to be falling down despite working multiple jobs. People weren't getting anywhere. Here's what he said, right? Pop my notes away. Got it there somewhere. He said confidently, there's so many people going homeless. I can understand it. Not everyone can hack it. People break. There's a lot of pressure. I work 2 jobs, this and my repo business. My wife works 2 jobs as well. All we want is to get a holiday every year and not worry about having a nice meal out from time to time. It shouldn't be this hard. Remember I said everything looked like it was thriving? But if that facade is held up by exhausted people working every hour God sends them, well, guess what? It leads to despair. And this is the economy for most people most of the time. It's why I call it the survival economy. That was my experience until relatively recently too. And if there's no respite and there's only 2 choices, you're going to go for the one that promises to break the way things are. What do you got to lose? Inflation was the thing Trump voters kept referring to. And in the perception, the perception that it's still high, I mean, it's not, but that's the perception, shows that bouts of inflation, regardless of pay increases, equates to being poorer. Trump voters wanted prices to be like 2019 again. Prices, not inflation. Never mind that to achieve that, you'd actually need at least some temporary deflation to get it. Try selling deflation to an electorate hooked on ever-increasing real estate values. Don't think Trump would tolerate that either. Now, of course, who doesn't want things to have a simple explanation? boiling the hopes and aspirations of 346 million people down to a few glib political talking points, then offering a binary choice of only two human beings, forces a ridiculous amount of projection onto candidates. It's a toxic way to make political decisions. But this single issue appears to be way above identity politics or foreign wars or wrecking the biosphere or even very positive GDP growth. Was GDP supposed to be the economy stupid argument? Obviously not, because prices have become shorthand for the feeling that any effort one makes to get ahead will be for nothing. And as a common story passed between a lot of people, they'll have a lot of currency, excuse the pun. And, it creates a lot of solidarity between very different people. We may all disagree on a lot of things, but even the Taliban accepts US dollars. You can't get people to buy into much else other than their own interests and their local community if they feel they're in a survival economy, no matter how many jobs they have. So, of course, concerns about civics and identity and rights are vital. And to borrow from Ralph Nader, who was asked after the election if democracy will survive this, said, no, of course not. But Trump was once again successfully weaponizing people's economic insecurities and demonized everything else. He won't change this story, by the way. Well, not without dumping the entire current system and creating deflation, which would simply be a different form of austerity. I can't see that suiting Trump's interests, but who knows? If we can avoid that, according to Ty and Douglas's modeling, there'll be a link in the description after the show, inflation will be back for round 2 in just over a year under the new Trump administration. And it's going to be very interesting to see if our guest's analysis is similar. Harris v. Trump, therefore, was a false choice between two faces of the same economic order. Do you want salt or pepper in your fish milkshake is really not a choice at all. Remember, we're talking about economics here and not civics. The United States may be about to get a civics lesson that it didn't ask for, good and hard. But this is a show about economics, not civics. And so Edgar E. Peters is here with us today to look ahead at what a Trump administration could mean in the markets and beyond. Ed is the founder of a completely unique form of analysis called Fractal Market Cycles and Regimes, which aims to explain how financial markets behave in ways that resemble patterns found in nature, such as the breaching of trees or the shape of coastlines. These ideas build on the mathematics of fractals, which, like markets, can also be split into parts, each of which is a smaller approximate copy of the whole. He's the author of 3 books and several papers on quantitative investing, behavioral finance, and economics and market cycles. So let's get him on here. Ed, welcome to Steve Keen and Friends.
Thank you. Thanks for having me.
It just gets cut off like that. Shunk, that's it. That's the level of live audience we have here. But it's great to have you. And look, I can't feel I've just simplified what you do far too much. So if you could just help us understand it, perhaps explain your work again in your own words would probably be beneficial for everybody.
Okay, well, it goes down to how markets, it's much like what Stephen Keen says, markets and economics, economies are complex adaptive systems, right? So they're determined by interactions and basically cycles which repeat but are not exactly the same. And there are a number of, the way I've worked it recently is that it's a number of different cycles which interact with one another. So we have very long-term cycles and then very short-term cycles. The very long-term cycles are tied to levels of inflation, and also a second very long-term cycle tied to financial instability, the Minsky effect. And interacting with that are the more near-term effects, which are the economic cycle and or the business cycle and the market cycle itself, which are very closely related to one another. And then in the much shorter term, there is a cycle tied to reflation and disinflation, or even deflation if that occurs. So these all interact with one another, much the way that if people are familiar with the Lorenz attractor, which is the owl-eyes thing that people use for chaos theory, it's basically 3 dimensions and they interact, but the patterns don't repeat itself, even though in the end you end up with those owl-eyes type of graphs. In this way, these cycles all interact with one another. And what it means, though, is that we go through it. I think of it as like a market climatology. That's the way I refer to it. the way the climate works is that we every year we go through 4 seasons, right? Go through fall, winter, spring, and summer, but the quality of those particular seasons, each time we go through it, are not exactly the same. And a lot of that is tied to longer term events like the El Nino or La Nina cycle. So whether we have a lot of hurricanes or not a lot of hurricanes depends upon whether we're in a El Nino or a La Nina. And so in the same way, we can have droughts in certain parts of the country, of the world, and then we have typhoons in the other parts of the world and flooding. But we go through the same 4 cycles every year, right? Go through them one after another. And we've imposed a certain regularity on them, but that's based on lunar movements, which actually have nothing to do with the weather, very little to do with directly with the weather. So you can imagine if what we try to do with market cycles, or what people expect to happen with market cycles, is imagine if we needed to determine that the summer was over when we hit the highest temperature of the year. Okay. After that, it's downhill. The summer's over. We're going into the fall. Imagine if the weathermen or weather people had to determine that, and that's how we judge their proficiency on whether or not they could predict the highest day of the year. And that's what we expect market analysts to do, right? We expect them to predict this is the market top now. It's downhill from here. You should all get out. But with markets, just like the temperature, it's just not possible because of the dynamics that are involved. So in my model, what we have are the longer term cycles, or regimes, actually I call them, determine the quality of the shorter term regime. So if we have leverage and we have a bear market, then we have a very bad bear market, because leverage causes other financial instabilities. However, if we have a bear market and there isn't a lot of leverage in the market, then the bear markets tend to be fairly shallow and short. Also, the recessions tend to be shallow and short as well if we don't have a lot of leverage in the system. So that's basically the way it works.
So I won't pretend to be out of my depth, and I'll be glad to get Steve and Mike on in a moment as well. But just an observation that occurred to me as you're saying that is, take Ray Dalio's massive, you see the cycles he's got on his graph, and it all looks like clockwork. And my instinct was, hang on a minute, nothing works like that. It's not like, we don't live in a clock. We live in a natural cycle, and there's loads of variables going on. So I've always wondered if, there was a much more organic kind of approach to, or basically much more complex and sophisticated approach, more like climate and definitely more like nature. So if I've got that impression right, then I'll be learning a lot tonight. So it sounds good. Let's get started the show in here. Let's get Steve on. Here he is.
Hi,
How
guys.
you doing, Steve?
A bit on the tired side, I've got to say. I flew back from the States. So I was actually in the New York on the day of the election and left the day after. So it was not a bad time to leave America.
Was that
still getting
or were you there specifically for that?
I went over for giving a paper at Yale University about how wonderful William Nordhaus's work has been on climate change.
Right.
Okay. And, thank you, William. You've managed to solve all the problems of capitalism by destroying it. That can be said to him shortly. So that was fun. And then we left it. This is with Carbon Tracker, which is the group that financed my report, loading the dice against your pensions, talking about the impact of Nordhaus's nonsense and that of other economists on how financial advisors value pension portfolios, and saying that fundamentally they've told you that, if my favorite actually is my own superannuation is funded from Australia, Uni Super. And because I was writing the report for Carbon Tracker, I got their annual report, and they talked about how 3 degrees have caused catastrophic damage, yada, yada, yada. At one point they said 4.3 degrees is an acceptable risk for your portfolio. 4.3 degrees. According to most scientists, your portfolio at 4.3 degrees, if you're lucky, will consist of bows and arrows as well as sticks and stones. But just nonsense out of the economists. So we left time at the end in case we meant to talk to any potential philanthropic funders, but that didn't happen. So I spent a few days bumming in New York and waiting for the election. Recorded a couple of videos about Trump. You may have seen those, Trump and Musk, which was good fun. But yeah, so it's good that I could say I left the country the day after it got taken over by Donald Trump again.
Yeah, I think I'm not sure if I don't feel like I'll be back for a while, but that was not just because of Trump, but now it feel less inclined to, I must admit, from over the side. But
well, I'm back there again in December to work with but one colleague of mine at Austin University, Kerry King, on incorporating energy into mathematical models of the economy. He has a model called Harmony. It's spelled Harmony, and I think he's been doing it for decades in MATLAB, and he's decided to spend the time with me over Christmas and put it across to Ravel. So that'll be an intriguing episode.
So Steve, what would be your first question, do you think, for Ed, since especially on the hot topic of what's likely to be going on in the next months and years? What's the easy way into this, do you think?
Well, thank you, first of all, from Paul Trainer for the donation. Very welcome. I don't think there's going to be another market crash in the sense that Ed and I have been co-predictors of in the past, because that was driven, as Ed mentioned a while ago, by leverage, excessive leverage. When you get a bear market with leverage, you have a total collapse like we saw in 2000 and then again in 2007, 2008. I think what I'm waiting for this time is what I'm calling a climate Minsky moment. And when that happens, there ain't no bottom. Okay. Because when people realize just how completely they've been conned, both by the financial sector and by mainstream economists, about how trivial the dangers are for climate change, and the nature begs to differ, says, hey, I've got this little thing here called the second law of thermodynamics. Would you like to feel it? When that starts hitting, then at some point we're going to go, holy shit, the market is massively overvalued. What do we do? So I think we're going to see at some stage the greatest rush for the doors ever. But what's going to cause it? What's going to trigger be? You simply cannot predetermine that. But the fun thing would be if it happens during the next 4 years, and there are reasonable odds that it will. So it'll be on Trump's watch that this happens. So I'm just trying to warn him that maybe you shouldn't be so skeptical about climate change.
That must be that may help things a little bit.
I'm wondering about that.
I'm wondering about that myself.
Yeah. I've seen one page Musk came out with a range of proposals about how to solve the climate crisis, which was an engineering approach, of course. I haven't read the document, so I've got to take a look at it at some point. But realistic ideas for carbon sequestration, component ideas about how you can. He's very much a solar advocate rather than nuclear. And that's something which separates him from a lot of engineers. I know a lot of engineers are very pro-nuclear. He's pro-solar. And he had concepts about battery storage and so on and so forth. So I would like to take a look at it, because in some ways that could start becoming energy policy for the United States in the next 3 or 4 years.
That would be a net good, surely.
Well, the climate issue, though, might come through from the insurance companies, actually.
Oh, yeah.
They start failing because, I mean, the 1907 earthquake caused or the 1906 earthquake caused the San Francisco earthquake caused the Panic of 1907, which then led to the establishment of the Federal Reserve, because J.P. Morgan had to bail the U.S. banking system out himself. He decided who was going to survive or who wasn't going to survive. And we may run into the same sort of issue if if enough insurance companies have problems, and that's likely, then that will spill over into the banks, and that then will cause all sorts of issues. So that could be where climate change will actually lead to a financial panic, just as it has in the past.
Yeah, I mean, one of the interesting things about the isn't it wonderful that cyclone that first really demonstrated increased power of storms was Cyclone Milton. Yay!
Cyclone Milton.
I only believe there's Cyclone Ain or Cyclone. Who else? Well, Paul doesn't mean much. Cyclone. That's his last name. Cyclone Friedman, Cyclone Rand, or Cyclone Samuelson hit. But that Cyclone Milton, when it hit North Carolina, it took out the silicon mine, which is one of the major components of the production of microchips around the world. It's used to draw crystalline silicon out of the fluid to draw into the crystalline structure, and it's the purest silicon on the planet. And those mines were both shut down by the floods caused by Milton. So this is just how, and this comes back to the fractal concept as well in many ways, how fragile the system is, because people have this concept based on the equilibrium nonsense you and I've been fighting for our whole careers, and the idea of large numbers and drowning out small deviations, and therefore everything happens in equilibrium. Bullshit. And then when you look at, like, for example, and one of the most critical industries for modern society is silicon wafers, and there is literally one mine. I think it might be one mining site with about 3 mining companies mining this ultra pure silicon, which is an essential element of producing silicon chips for modern technology. And that one cyclone took out those mines. Now they'll come back online, but it's a question of how long will it be until it happens. And so one storm, and you have what people don't realize, that they don't realize there can be a critical link in a system as huge and complex as the global economy. But that's one of several.
We'll bring on Mike.
We saw from the thing with inflation that people don't understand supply shortages as the cause of inflation.
Yeah.
They've all been brainwashed to think it's all monetary policy all the time.
And it's all wage-based. That's the other thing.
Yeah.
I mean, that's why Isabella Weber did a very good job of attacking that with her. Have you seen Isabella Weber's research on the causes of inflation?
No.
Worth looking at. It's fundamentally Koleski's idea that prices are set. The 3 main factors are markups by firms, money wage worker demands by workers, whether that's demands or low unemployment causing firms to offer higher wages, and unit productivity, unit output costs, and that largely, those are where the supply shocks come in. So those are the 3 factors. Now, when you look at how neoclassical economists redefined inflation, they saw it as entirely the idea of effectively it came down to controlling wages. So, and the way to control wages was to increase interest rates and therefore reduce demand. I mean, it's got far crazier than that. If you read the modern neoclassical models, they all blame it on fluctuations in consumption, which is crazy. But the focus of the Phillips curve argument was increase unemployment, you reduce the rate of inflation. And that's what's been done by the interest rate rises, or that's what they think's been done. Right. But you look at the original causation that Phillips argued it wasn't that increased unemployment related to inflation. It was unemployment related to the rate of change of money wages, which is only one of 3 factors that Phillips concluded in what actually causes inflation. And the other 2 factors are the ones that dominated the last cycle, both changes in markups by corporations and supply shocks, which came through the productivity index. And, interest rate increases probably had bugger all impact on the inflation rate. It was basically the supply shock washing through the system. But now we're in for, the supply shock of all supply shocks are coming our way.
Just before we bring Mike on, just an observation is going back to Nordhaus and the underestimation of climate. There's I happen to do filming for a company that's in the reinsurance market. I went along to an event to film it. By osmosis, absorb what they're talking about. And I mean, basically, they're looking at a bumper set of years coming up, because the assumption now is that there'll be enough catastrophe, because reinsurance, of course, the guys that back the actual insurance companies, and they're expecting that because of these raft of massive catastrophes, because they're bigger than normal, they'll be into a cycle where the premiums will go up, and so therefore the reinsurance markets will also have a bumper few years. It's really hard to listen to it and not think, well, how does that benefit anyone? There's a whole model built on that. This is that's the house of cards stuff that you see right in front of you, and you're like, when that falls apart, people can't afford the premiums or don't want to live there, and all sorts of things. I don't know. It's crazy. The whole thing is a feedback loop. But let's get Mike on and get the whole team assembled, as it were. And here he is. Welcome aboard. Welcome back. And
see everybody. Hi, Ed.
I'm loving the new look, Mike. The house is looking pretty smart.
Yeah, I got a cool pool I'm going to dive into when we're done here.
You didn't, yeah. I'm pleased you didn't choose the spaceport or the what other options were there?
I only had the brick wall or this for some reason.
Oh, definitely. You want the pool. Good on you. How you been? You a good week?
Yeah, just same old rinse and repeat. I guess rolled down to Yale and hung out with Steve for a day. Last Friday, so that was kind of fun.
Yeah.
And just doing econ and doing dynamic modeling and situation normal.
Very good. Now,
have you actually seen any of Ed's work, by the way, Mark? Because on the fractal market, have you seen Ed's work on the fractal markets hypothesis?
A little bit. I did a little bit of research prior to today. Yeah.
Okay.
Like chaos is cool. I used to teach at Notre Dame with Ned Lorenz, who is Ed Lorenz's son, and he's an economist, Cambridge trained economist.
Oh dear.
Oh, really? Ed Lorenz's son is an economist? Wow.
Yeah.
Which Cambridge? Cambridge, UK, or Cambridge, Massachusetts?
Cambridge, UK. Yeah, I believe.
Sorry?
Cambridge, UK, I believe.
Okay, because that used to be post-Keynesian. Now it's actually staunchly neoclassical. So I wonder.
Yes, yeah, but I haven't taught there for 35 years, so I don't even know if he's there anymore.
Okay. Yeah, so Ed, why don't you go through the fractal markets hypothesis for us, because it's something which I'm familiar with, but our live audience here doesn't know a lot about. So give us a bit of background.
Okay, yeah, I'm glad to do that. This was the beginning of my cycle and regime work, and it basically dealt with market cycles. I've always been for those who don't know me, I've always been a money manager. All right, I'm not an academic, which I sometimes get criticized for.
I like you even more.
Thanks. Yeah, I've never been an academic, and I don't even have a PhD. I have an MBA because, frankly, when I started, I've been in the business since 1978. And in the beginning, if you had a PhD, people looked at you with suspicion. They didn't like all the math as it was. If I had a PhD, it would have been even worse. But the fractal market hypothesis is based on the idea that unlike the efficient market hypothesis, which doesn't deal with investment horizons at all, the fractal market hypothesis adds the idea of investment horizons. And the reason for that is tied to fractals. For those who know fractals, fractals are supposed to be self-similar at different levels of magnification, right? And so in a physical process or a physical object, I'll take the lungs. Okay, you can take trees too, but I like lungs. Lungs start with a main trachea, and then they have generations of branches that come off of that. Now, the average diameter of each branching generation goes down according to a power law. Okay, but the actual diameter of the individual branches varies. And each generation actually has a distribution around that average. Now, the reason for that is that as the lung is forming, if it actually went down according to a strict power law where every branch was exactly the same, then if something happened in the environment while the fetus was being formed, and one generation was off by a little bit, then the rest of the generations would also be off by even more, and it would increase the probability that the lung would not function. So what this fractal branching does is it makes the lung more resilient to error. Okay. So what I did in the fractal market hypothesis was rather than look at prices, which is the way people often look at fractals in markets, I was looking at the distribution, and rather than the way I looked at it was investors all have different investment horizons. And that's what equates to that scale, that power law scaling. So rather than having investors which all have the same investment horizon, which is what the efficient market hypothesis and standard capital market theory assume, instead we have an infinite number of investment horizons from very long to very short. And why that's important is that the way investors interpret information depends upon their investment horizon. So something that would be considered a sell signal at the short investment horizon, which are typically technical, momentum-based things, a long-term investor who would have a long investment horizon, who's more fundamental, would consider that a buying opportunity and step in and stabilize the market. So when we have this distribution of investors on their investment horizons that cover a large number, then the market is stable and we have low volatility during those periods. But every so often, what happens is that something happens which causes long-term investors to question the long term. What they think is going to happen in the long term doesn't necessarily apply anymore. It's usually an economic thing, but it can be a geopolitical event as well. Okay. And when that happens, long-term investors either leave the market or they become short-term investors themselves. And the investment horizon of the total market becomes much more uniform. When that happens, then when information comes into the market, everybody interprets it pretty much the same way. So if it's good news, everybody buys. If it's bad news, everybody sells. And so you get increases in volatility, which persist until, and that's when all the fat-tailed events occur, persist until the long term becomes more certain again. And then we go back to a period of low volatility and stability. Interestingly, using proxies for the investment horizon, I tend to use a combination of market of economic information and implied volatilities for this. The low volatility periods are where you have the highest returns. So you have the highest risk return characteristics during those periods. During the periods of high volatility, you tend to have low returns. So unlike the efficient market or capital market theory, which assumes the more risk you have, the more return you get, it's actually the reverse of that. And the market's less risky. These two regimes, by the way, also explain why Fama's work in this area. He tried to prove the relationship between beta and returns back in the 60s. And he found that the capital market line was flatter than it was supposed to be. And that was the reason, was he was averaging these two regimes together. And when you average these two together, then you end up with a lower risk return trade-off than you should on average, because it's actually higher in one period and lower in the other. So the market goes back and forth between these two cycles, but my more current work also ties in with the Minsky effect, which we were talking about, the effect of leverage and so forth. So if we have a high volatility period with low leverage, then typically you actually have pretty good returns at high volatility. But if you have high volatility at high leverage, then that's when you get the really bad bear markets on all those fat-tailed big events. So that's what the fractal market hypothesis is about. When it was originally, when I originally wrote it, and I wrote it 30 years ago, okay, this was back in 1994, it was criticized as being untestable. But since then, and at the time, I couldn't prove it. I could only show that we had these periods of high and low volatility. But since then, a number of academics have used wavelets, for instance, to test the fractal market hypothesis. And sure enough, they found that during periods of crisis, like the global financial crisis and the tech bubble, and the COVID pandemic, all of which occurred after 1994, of course, fractal market hypothesis does hold. And during those periods, in almost all markets, the high frequency trading is what dominates markets rather than low frequency. And during those low volatility periods, you basically get no dominating frequency at all, which fits right with the fractal market hypothesis. So is that clear?
It helps a bit. It helps a bit. I mean, the whole thing about the box dimensions and the different time windows you apply to work out like the Hurst exponent is one way of saying whether a market has got long-term memory and is fractal or not fractal. That's probably worth explaining as well, because and I did all those calculations in MathCAD. I'm most annoyed that MathCAD has been taken over by a bunch of turkeys who've made the software bloody unusable, and I've lost all my damn files. So I've got a couple of spreadsheets, but nothing like what I had back when I was actually teaching your stuff to my students.
Well, I when I did it back in the 90s, I used a program called Gauss, which I don't think exists anymore, but it was a very high level language that we could use things. Back in the 90s, my biggest problem was getting data. Okay, something we all take for granted now, but it was very difficult to get data back then. I did use that. The fractal dimension, for people who are familiar with it, the fractal dimension of the market is tied to long memory effects. This is Mandelbrot's insight. He did a lot of research on rescaled range analysis, which was an analysis created by a British hydrologist back at the turn of the 20th century. And he applied it to a number of natural phenomena and found that it worked. And he felt that it also worked for markets. Then he wrote one paper about it, promised that he had lots of data on markets, which he was going to use it for back in 1971. And then he never did anything on it again.
Keep your powder dry just for a moment, Ed. Sorry to interrupt. But there'll be mutiny in the ranks if we don't do top chatters this early in the show. We love our chatters. We love them being here. We just like to remind them that we know they're there, and we're trying to bring in questions for them too. So let's jump to top chatters. Who's going to do it this week? If there's the big question. I think I've got away with not doing it for pretty much the whole time, haven't I? So there's probably time.
Yeah.
And am I going to go for speed and just really completely murder it or not? That's the question. Or slow and deliberate. Let's give it a go. Drig-Eye, Tony Wilson, Ghost on the Half Shell, Mod Ibrahim Hussein, I'm guessing that's Muhammad, but short. Phil Waller, hello Phil. Douglas Dowell, JD, Algorithm, Sherry Wise, The Herald of Change, Blue Bay, Go Meta with Ollie Sharp, Joe Politico, yeah. Paul Trainer, BSC, Sean Damratowski, Reagan, Boychuk, Long Defiant, Gavin Van, Stock Apocalypse X, Magala Raj, TR, Lana Dell Hates the Clock, Sonic Personic, Michael De Souza Cruz, Thomas Darlington, Big Hammer, Life 42, The Universe, Larry Summers, Shot, Jupiter, The Hasty Ent, John Watson, Spoonlookle, Lone Candle, Christopher Dobby, Web Freaks, Prashanth Kamath, David Collins, Bill Goggin, Cabin Economics, George Robinson, John Troughton, Bruce Cossadine, and Benjamin War. Got there somehow. There's a couple of new ones in there, but lots of familiar names.
I'm wondering who Benjamin War might be a colleague of mine on energy research. I'm not sure. I'll have to find out. Maybe get a comment from Benjamin shortly.
Yeah, Benjamin, let us know in the chat. Sorry, Ed, I had to interject that point. I've probably broken your train of thought, but go ahead if you can pick up. Or
let's see, what was I talking about?
Well,
it's the problem when you get old, you know.
Yeah. I've got another thought. If it's okay to jump in, I thought if it's not too much to ask, what from your point of view is the vantage where we've been? Where exactly in your cycles? How would you describe it to where we've been recently, perhaps, and where we are now? Where do you see us in the cycle? What's a way to examine that, or is that not useful?
Well, we had been heading into a period which I considered a fragile cycle. While the leverage levels in certain areas are not that high, I found that by other measures using the non-financial leverage level in the economy, the U.S. economy, those are fairly high. And so there was a chance that if there was bad news coming into the market, that it would have been taken badly. So this transition to a fragile state occurred back in, I think it was in September. Okay. Now, what's happened since then, of course, since the election, is that a lot of elements are starting to become more optimistic again, at least in the near term. So we may see a fall back to a more positive leaning environment going forward. How long that lasts is unclear. One of the things I found about presidential elections, I've been with the markets with them a long time, and a while ago I was looking for this study, but I couldn't find it. I did it for a client, and I found that I manage money for institutions. By the way, that was my thing: pension plans, foundations, and endowments, sovereign trust funds. Was that for presidential elections, if the business pro candidate was leading up to the election, the market went up prior to the election and then went down afterwards. if the anti-business candidate was in the lead, then the market typically went down before the election and then went up afterwards. Now, this time around, it was considered a dead heat. And because of that, the market just sort of wandered around quite a bit. But then it did take off at the end. So clearly there was some worry that a less business pro candidate would win. Now, having said that, Trump is not really a pro-business candidate in the typical way we would think of it, since he likes to dictate to businesses where they should invest, where they should build their product, and how they should sell it to the marketplace, which is not exactly a pro-business thing. Despite that, the market seems to think that him being elected is good news, and because of that, the markets did take off. But what I also found was 3 months after the election, the market was back to the same place, no matter who won. Okay, so it didn't really matter. In one case, the market went up and then down. In the other case, it went down and then up. 3 months later, on average, the market was pretty much where it was. And I interpret that to mean pretty much that leading up to the election and shortly afterwards, there's a lot of speculation about what the candidate's going to do. But in the end, everybody realizes, hey, it's not what they say they're going to do, it's what they actually do that matters. And it takes a while for those things to be put into place. So will Trump be able to put on those 60% tariffs on China and 10% tariffs everywhere else? Will he be able to cut taxes for all the people he said he's going to cut taxes for? You know, is Musk going to be able to come in and take $1 trillion of waste out of the government? You know? That sort of thing. It's not clear how he's going to do any of that because he hasn't said how he's going to do it. And so what will happen probably is a lot of this rally will start to evaporate in the next couple of months. And while everybody waits to see what's really going to happen. Going up to it, though, I think there was some anticipation that there was potential for violence and other things which could be highly uncertain and disruptive to everything. That, of course, didn't happen, and so that everybody was very happy about that. But I think now we're going to go back to reality. What is it he's actually going to do, and what can he do, and what impact is that going to have?
Yeah, in many ways, the reality is, in the past at least, was there's a lot of things he talks about, but then gets distracted and either doesn't do them or it was rhetoric to some degree. At least it seemed. Mike, what have you been thinking while been talking about this? You must have, from your point of view, there's got to be a system dynamics point of view on fractals in this space and what Ed's been talking about.
Yeah, and we ran a trading system project center at WPI for 15, 20 years. And so we had kids looking at Fibonacci patterns and all sorts of stuff. So, everybody wants to try and predict the market and what have you. And it's usually, that's not the greatest of strategies usually.
Yeah.
But from a system dynamics point of view, we're talking about trends and cycles, really cycles, right? And multiple cycles. So you hear a lot about in the economics literature, the trend and the cycle. There are many cycles in the economy, right? There's the business cycle, which everybody thinks about, and it's in the popular press, but you have, kitchen cycles and juggler cycles and Kuznets cycles and Kondratiev cycles. And the question is, and Ed is absolutely right, they do interact. And, a very simple exercise, you can take a short run cycle riding on top of a long run cycle. And what do you learn from that? Just plotting it. And that is on the way up. When the long cycle is going up, the short cycle has longer upturns and shorter downturns, right? It's the opposite on the way down. So you can start to find a few patterns, right? When you think about, various cycles in the economy with different periodicities and what have you, and find sort of patterns. I don't think you can predict exact turning points in the stock market or something, but it's, you can directionally kind of get some insights, I think. Then the other thing I was kind of thinking of was, what causes cycles from a system dynamics point of view, a dynamic modeling point of view, a feedback point of view. And it's negative feedback. It is servo mechanisms, thermostats, guidance systems, cruise control on your car. These are all examples of servos. You have a target, and then you have the state of the system. And if there's a gap between what you want and what you got, the actual temperature in the room and what you'd like it to be, the actual speed of your car and what you'd like it to be, corrective action is generated. Ed said these are adaptive systems. That's 100%. The system adapts and tries to bring the negative loops, try to bring the state of the system into alignment where what you want it to be or where nature wants it to be, homeostasis, balance, equilibrium, if you will. So wait a minute, aren't we anti-equilibrium here? Well, here's the problem. When negative loops, let me pause before I get. So the Adam Smith capitalism, invisible hand stuff is two pure negative loops. The law of supply and demand is negative feedback loops. The orange crop freezes overnight suddenly in Florida, and the price of oranges goes up. So what happens? Law of demand says, well, people will demand less oranges or orange juice. They switch to grapefruit juice or whatever, right? And then the suppliers say, hey, let's bring in some oranges from abroad, or let's start planting more trees. And so supply and demand both adjusts, and it brings things back into harmony. But you get oscillations when the corrective action is delayed. So if there's a significant delay before the corrective action comes online, it's often no longer the right amount. By the time it gets there, it overshoots and undershoots the target, right? And so how good the system is at correcting the error determines whether it's damped or sustained or even exploding, right? So negative loops, these things that are, think about your human body. When you go outside in the summer and you get above your desired temperature, you perspire. It's a homeostatic process. When you jump in a freezing cold pool and get out, what does your body do? You start to shiver. It's trying to warm you up. So this is quite common. One last, so negative loops generate cycles. But what happens if you have the other kind of loop, a positive loop, self-reinforcing process? So the orange crop freezes, or the price of condominiums in Florida instead of oranges goes up. Instead of the law of demand kicking in and saying, oh, I'll live in a trailer or something, I'll move, whatever. People say, aha, I can speculate because I think it's going to go higher. And then they buy more and it goes higher. It's a self-reinforcing, self-fulfilling prophecy. But here's the thing. When systems grow with positive loops exponentially, they don't do that forever, except maybe the universe is expanding exponentially. We don't know. But except for something like that, there's limits.
Bernie Madoff was exponential forever, wasn't it? But anyway, that was a different story. Bernie Madoff's investment plans were exponential forever.
No, they have limiting factors. Yeah. But that's the point. At some point, somebody says, hey, it ain't going no higher. I'm going to get out, take my profit. And they sell, and it starts to slow it, and then it rolls over, and then everybody piles in again. So you get into this issue about, from a feedback perspective, of manias, maybe fueled by social media, rumors, whatever, whether it's War of the Worlds, and I think the Martians are coming, or what have you, and you can get these speculative bubbles and what have you. And that really confounds the oscillatory stuff that's going on. So there's a lot going on. Last point. Colleague of mine some years ago, Eric Mosekilde, was a Danish physicist. I visited with him in Copenhagen in his laboratory for 3 months or something like that back then. And he was doing physiological modeling. He was working with physicians, and they were modeling systems first in animals and then in the human body. They would model like a sheep's kidney with dynamic modeling, and then they would shock it with a drug, a simulated drug, and see how it performed. And then they tried on a real sheep's kidney. And then he had his student, I think it was his students, he was paying people to lie in a hospital bed, and every half hour, every hour, whatever it was, they would take a measurement of something. If somebody says to you, what's your cholesterol? What's your blood pressure? And you say, my blood pressure is, 110 over 9. That's at that moment it was measured. But Eric was saying, over time, let's find out what the measurements are. And all of them were oscillating. And he said, the systems of the human body oscillate. Okay, all of them. That's his hypothesis. And his data was kind of showing that. He's trying to model it and stuff. But his hypothesis was, look, all of the systems in the human body, if they all oscillate, or all of the systems in the economy, if they oscillate, have to be chaotic. They have to be. Because if they're not, they would entrain. So entrainment is the dynamic phenomenon, like with pendulum clocks. The clockmaker, the clock shop owner in the morning starts the clocks, and they're swinging like this. And at the end of the day, the oscillations are entrained. Fireflies come out at twilight, and they're oscillating at different end of the night. They're all flicking together. They entrain. It's a common dynamic phenomenon. And he said if the human body, all those cycles were not chaotic, because chaotic signals can't entrain.
Yeah.
Everybody would be higher than a kite, and then they couldn't get out of bed, and higher because the signals would all entrain. So it is probably true that all these cycles in the economy have some sort of chaotic signal, because otherwise everything's entraining. Now, I don't know that that's true or not. I'm just throwing that on the table.
That's a very nice one, actually, Mike, because the fact in training, signals which are non-chaotic can be forced to harmonize by the interactions between each of them over time.
Yeah, the vibrations on the wall of the clocks or whatever.
Like one of Ed's, I remember reading this from the Fractal Markets book way back in either the 90s or the early two noughties. Hey, the two noughties, that's a good term. Was that you gave an example of a market dip, which was a serious downturn in the time horizon of a fund manager. And then if they only had fund managers in the system, that would have fed to a feedback loop that would cause the other fund managers to drop out and the market would collapse. But when you then had that downturn on the over the sort of yearly time scale of a fund manager, you then have for a day trader, the movement was a buying opportunity. So the day trader steps in and then does the alternative buying. So you get stabilization coming out of the interaction of numerous chaotic processes. And this is one of the main points about if you apply the fractal markets hypothesis to the market and compare it to the efficient markets hypothesis. The efficient market hypothesis fundamentally says you're going to get equilibrium outcome. You're going to get here's the there's going to be a mean rate of return at a standard deviation, which we can describe using Gaussian statistics, and anything more than 5 standard deviations one way or the other is impossible, just completely ruled out. Whereas the fractal markets hypothesis gives you a power law of the scale of movements, and you get the possibility for 20 and 30 and 40 standard deviation movements.
Yeah, and you have fat tails. And
like that vindicates Ed's work, because we saw that in 2007. I think also in 2001, there were a couple of 20 and 30 standard deviation movements. Right. That's simply impossible. We got so many of them. It was showing that the fractal markets hypothesis is correct, and the efficient markets hypothesis is a myth.
The other point Ed made that resonated with me when we were running these trading system projects was that, you had, we didn't do flash trading, of course, but you had people who wanted to be scalpers, day traders, swing traders, longer term traders, and then going into long-term investing. And the time horizons were very different for the kids and the strategies they pursued with that. And then Ed was absolutely right. Then they'll change their mind when something would happen, and they'd have positions on, obviously simulated positions, and it's like, dude, you can't be, you have a system that you've designed here. If you change what you're doing in midstream, now the science is out the window, because now you have a different system. You might not even consciously know what you're doing, but people do that. They change. They not only have different horizons, they change their mind when something happens. And so Ed is spot on with that in my experience.
Speaking of day traders.
Oh, yeah.
Here he is. Oh, he's Mike Gradzitsky tonight. That's great. Oh, there he is. A correct name now.
Going on there.
Yeah.
It's a much younger me. I wish I was younger, but.
Well, look at this. You've got Mike. You've got good hair for your age, so
it's hanging in there, fingers crossed.
We're pretty strongly haired here, all 4 of us. That's 5 of us. Yeah.
If there's any more patch at the back happens, I'm going full Bruce Willis. It's gonna be
gone. Just wear a hat.
Yeah. No, it's gonna be gone.
Or a little beanie.
Can't wear a beanie.
Does any fractal work done up in your day trading tie?
So I wasn't even going to come on, but Ed was saying so many interesting things. He started off with chaos theory, and I was like, damn, okay, maybe I should come on for this one.
Yeah.
So yeah, we have your day trading and your long-term trading. And day trading, what I do in the morning, I don't use any fundamentals. It's completely technical gambling, as I like to call it. Risk management. We'll call it risk management, not gambling.
It's gambling. At least you're honest.
Yeah, that's what that's what it really is. I rarely look at a piece of news in day trading unless it's some overnight, big gap in the market, and I want to know, is there some validity behind its gains or its losses if I'm shorting. But in the long term, so what we're doing at Modern Macro Technologies, it's entirely modeled. And so I just quite a few things that Ed was saying. For one, I treat the economy and the markets as a complex system. So he was, I think, saying, you're not going to be able to predict that exact turning point. It's, picture your hurricane climate models, and you have a bunch of sets of models, right? And you hope there's some sort of cone of uncertainty, but none of them ever land exactly on the money. And that was one of the first things I was encountering as we're starting to put out macro predictions with my national model. Is we actually needed 6 of them, really. So we have our hurricane pass, right? And each of them have slightly different sets of assumptions. Not too much, but anybody that knows like chaos theory, a small change in its initial condition, you can have radical deviations down the line. So that was interesting. Another thing Ed was saying is that generally the market will return to its trend. So if the market, I think he was talking about the election. So, if it's not good for the business community, it'll be a sharp downturn. Let's say it's some temporal factor before the election, and then it returns back to its trend. Or if it was business friendly, there's a big climb, but people realize, oh, wait, this politician actually needs to implement what he's saying he's going to do before there's an actual fundamental change in the market, and it returns to the trend. And in the long term, what we're finding, like when we model it, all the indexes qualitatively take the same shape. They might have different index numbers, but the rate of change over, let's say, a year period, qualitatively, it takes the same shape. So if you see a bell curve in one indice, you'll see it in another one. The rate of change might be different. And what we found is that fundamentally, you can track that if you look at all your agents in the model and look at their equity. Now, what we found when we did that, and we just were doing simple pattern matching, because in our national model, we don't have a built, stock market. And we're like, okay, how can we build a module to represent that? And so we started just looking at the equity of the different stakeholders in the model. And when we put that over, I think it was the NASDAQ, it matched perfectly, but it was a year off. And we were like, okay, well, what's going on here? We're seeing qualitative, shapes that, the charts look right, but, our model says, well, it's a year down the road, not right away. And then we realized, well, this is all expectations. So the market's always reacting to news. And generally, we're finding that most of the time in aggregate, the market gets it right. So they're just a lot faster with that fundamental data. You will see the permutations of, random events, i.e., right now there's a bit of a boost because Trump is pro-business. So the markets are doing quite well. They'll return to its trend once we realize Trump has no way of implementing 60% tariffs on China, their biggest trading partner. But nonetheless, we just kind of noticed that in aggregate, the market is a representation of the fundamentals that'll happen 9 to 12 months down the road. It's just people are anticipating it and using some expectations of what that's going to be. So that was interesting, just listening to it all. A lot of this fractal stuff, I have no clue. I'm trying to educate myself by listening to Ed, so that's why I wanted to just sit back and learn. If he had some good ideas, I'd steal it for myself. That's what a good market guy does.
I'm retired now. You can steal stuff if you like.
But he
Yeah.
does have a good. Let's plug the. Now this is the book. I'm going to get this book, Fractal Market Analysis. I guess it's fairly old now, but
Yes,
it's
30
got
years.
kiosk. Yeah, I'm going to get this book, and I think maybe everybody else should think about getting it. Does it? Hopefully, it's still sold on Amazon.
Yes, it's actually still in print, but
Okay.
despite the fact that I get a royalty when you get new books, there are lots of used copies floating around. So
Oh, okay.
it'd
No,
be easy for you to
No
get used
pressure.
copies for it.
No royalties on the
Black-
secondary market.
bl-
Yeah.
black market. Here I come.
Yeah, no, like ABE, American Book Exchange, and places.
Mind
like
you, you've got to be careful on the black market. I just saw a while ago the hard copy of Debugging Economics is on sale on Amazon for $3,500.
Is it,
Was it signed?
I didn't want to be the first to say it, Ty. That was,
Okay, so
Wow.
I'd like to get a share of that check, but I won't.
Yeah,
If somebody actually buys it for three
I
and a
know
half
how
grand.
I know how our artists feel when.
Steve, maybe bid it up.
No, thanks.
Just to see what it can get to.
I don't have the room to short myself.
Yeah.
I'm short enough as it happens. Actually, one thing when I was using your work quite extensively, Edgar, I was also aware of the work of Robert Hagen, and he had what he called the inefficient markets hypothesis. Did you ever come across that?
Yeah, I did. I thought they were all variations on the same thing.
Yeah, pretty much. Yeah.
And Andrew Lowe had the adaptive market hypothesis, as well.
Mm.
So there are a number of attempts to more generalize the way markets work, given that the efficient market hypothesis and traditional capital market theory is all tied to equilibrium, which we know doesn't exist. So I think I said it in my book. Equilibrium is like the moon. The moon is in equilibrium, but it's dead.
Yeah. Actually, if the moon was in equilibrium, it'd be in the middle of the earth, and we'd all be dead.
Oh, that's true too.
It's
but its ecosystem is pretty static.
Yeah.
Uh,
If the Hagen stuff was actually similar to yours in terms of time horizons. Actually, I tried to find some of my old notes, and I've got more notes on Hagen than I have on you, unfortunately. Not because it's not that I didn't use your material. It's in MathCAD, and I can't access the files anymore. It's incredibly frustrating. But Hagen's thing was a similar sort of argument, and a bit like Soros as well, because Soros talked about people reacting slowly to news and then overreacting. So what Hagen argues was that rather than buying, like if you do the efficient markets hypothesis, you're supposed to take high volatility, high return, or low volatility, low return, and mix out your portfolio that way. What Hagen said, which was total bullshit, what Hagen is saying, you should actually pick the stocks that nobody else is picking, underperformers, stuff which will sort of slowly builds momentum, and then suddenly people jump onto it. And said if you actually go and buy, so his advice was to, when you look at the market, rather than buying what was supposed to be the best stocks, you buy the worst stocks. And that's where the gain came in. And quite intriguing arguments. And all this stuff comes down again to the complete absence of equilibrium and the completely misleading nature of trying to model a dynamic, non-equilibrium, chaotic process if it's equilibrium with a Gaussian distribution. Well, that's what still rules mainstream thinking in finance. We can't get rid of the bastards.
Right. It's very entrenched.
Sorry?
It's very entrenched. Yeah.
Incredibly, isn't it? It's like, did you read there's a 2004 paper by Fama in French called The Efficient Markets Hypothesis, Theory and Evidence. Have you ever read it?
Yeah.
They conclude that it should not be used.
Right.
Okay. That this is the hypothesis he championed for 40 years and said it should not be used.
He also said something interesting recently. Fama did. He said that there haven't been any big ideas since the 60s. Which I found a little bit weird.
It's your fucking fault, mate. Yeah, you suppressed all the good ideas.
Yeah, but he's completely ignored all of the things on complexity and dynamics and all the work there. But of course, part of it is I think when I started, when I was doing all of this in the 80s and the 90s, it was even among investment managers who were researchers like I was, you were encouraged to publish results, right?
Yeah.
Because that increased the viability of what you were doing and that it worked and so forth. It gave it qualifications. But I noticed in starting in the late 90s and then well into the 2000s that stopped. Okay, there's very little publication by investment professionals now of their research in academic journals, for instance. I mean, I stopped doing it because it took too long to do it. That's why I wrote the books, frankly, was that, you know, when you write a paper and it doesn't get published for 3 years, you get, you know, I actually published sent a paper into the Financial Analyst Journal. It was accepted. Then I wrote the second book referencing that paper, and the book came out before the paper did. You know,
Welcome to
that
academic
was
scandalized.
back in those days, but there isn't as much. So I think there's a lot going on that we're not hearing about. I'm sure, and you guys are both talking about.
So I was going to say,
which we haven't seen. So,
go ahead, Mike.
no, I was going to say, you know, Steve mentioned about buying stocks that are out of favor or something like that. It's kind of your value investing, Warren Buffett, Graham way of investing. Problem there, of course, is if you have a bull market, you can't find any undervalued stocks. It's very difficult, right? So you have to wait till there's a bear market or a downturn, and then you've got to have the wherewithal to buy and have a good strategy or have confidence in your strategy to purchase at that time. Going the other way, if you're sort of a momentum investor and you're looking for rockets, everybody chases the rockets. They wait till the rockets have taken off, and then they're like, oh, and then they're chasing it, right? So it's very hard. I mean, if you're a momentum investor, you've got to pick the rocket while it's on the launch pad and not after it's blasted off, because now you're chasing it, right? Or the other way is tough. You have to be have a stash of cash and be patient and wait for a downturn where the market is undervaluing a company. So it's hard. And then, if you're going to build your personal portfolio, you have your strategy, whatever it is, how many stocks are you going to put in that portfolio? Because at some point you're building an index. Just buy an index.
Just buy the index. Yeah.
And I've seen, I don't know, Fama said 15 or whatever, and past that, the diversity is not helping you. You're just building an index fund. Just buy an index fund. What I'm getting at is, I think for the average picnic basket, buy the S&P 500 and go play ping pong.
Yeah.
There's a lot going on. And the pros, they're going to take your lunch money if you try and outwit Goldman Sachs or something, So I just think it's really hard. Now, if you're a professional money manager, that's an entirely different matter. Now it's your job. You have a fiduciary responsibility and all that stuff to be on top of this stuff and to get an edge somehow. And if it's fractals or what have you, then you got something there.
So what if we would take the big policy elephant in the room and tariffs and as something to examine using your modeling, Ed? Is that so? I'm trying to get my head around if the idea that you're modeling what's going on in a market that's just responding to a lot of normal cycles, but when you introduce what would be a pretty big shock, right? Is that something that it's pretty straightforward for you to model? Is it part of your thinking? You just call that a shock and include that? How does that work, given that I know nothing about this area, obviously?
Well, tariffs, they're because they would be imposed by the government. They are an exogenous shock. Yeah. So the thing to be looking at there is what is the impact of the exogenous shock on things that are going on, and it may take a while to see that. We would see, we think we would see an increase in inflation from that. But a lot of that depends on the mentality of what's going on. Like one thing that I notice people don't realize, because a lot of people's careers have been built since the global financial crisis, right, which was a long time ago. But in a cycle sense, it's not, because that was a period of very low inflation for a long time. So if you came of age during a period of low inflation, if you're going to now go into a period of persistently high inflation, things will change. So one thing, the models, I have an inflation regime model. It's not very complicated, but it does look at whether or not inflation is at different levels, low, moderate, high, whatever, because markets react differently when inflation is at different levels, particularly bonds. Okay, bonds are are a very different asset. As we saw, everybody was surprised when inflation went up, that bonds and stocks became highly correlated. That always happens. Okay? We just haven't seen it since 1980, but it always happens. When inflation is high, stocks and bonds become highly correlated with one another. And so it was a surprise to everyone, but if you just look back, it was always there. It always happens that way. So looking at tariffs, the effect is whether it will push inflation up into certain levels, whether that does it, then also how the impact is on the profitability of companies. If in the last time around, in Trump's first administration, companies had no pricing power, and so they had a hard time passing those costs on to consumers. But now they do. Now they can just blame inflation, and everybody says, okay, and they pay the price. They don't like it, but they do it. So it's very possible now with people in a more positive inflation mentality, companies can blame inflation for the increase in costs. So they may get away with it. And in that case, we may end up with a period then where inflation then pushes up interest rates, and then we end up with a persistently high interest rate environment, which again causes other problems. So they all knock into one another, which is kind of a roundabout way of saying it, but that's basically what would happen.
And is it reasonable to think back to when a similar period in terms of these likely tariffs existed in the past? Because I don't think that ended well. So when would you go back to, if let's say they're implemented as even half of what is being said, what would be a similar period when the United States did that as a fully developed economy, not in the 1820s?
Well, they did it in the 30s, and the result was very poor, right? Yeah. It is difficult to go back to those eras when the economy was quite different, and even the structure of government was different, and what that all means. It always, I'm sure everybody here, it drives me crazy when I heard Trump talking about the 19th century. Give me a break. The 19th century is not going to give us any idea of what high tariffs would be now, or if you went to an all tariff income for the government. But still, it's because of that, it's very difficult now to say what would happen with tariffs when it comes to the global economy, because we are so much more interrelated now, and we're not as self-sufficient, and rightfully so, when it comes to manufacturing things. And it seems that people don't realize that if we manufacture things here, they're going to be more expensive. That's why we don't manufacture them here, in the States.
But it's too high. That was also taking advantage of cheap wages, which have now been pretty much eliminated in places like China. So, but actually, one thing about this, just Dave's benefit here, the things like the fractal markets hypothesis really say that news from the outside doesn't matter all that much. Okay, because what you've got is a system which is so internally self-referential, with so many competing time horizons on top of it, that the internal dynamics of the stock market itself determine most of its behavior. Again, this is something that does turn up in Ed's work, but it's also in Hagen's work. And he said he tried to relate scale of stock market movements to scale of major news events. And even the declaration of World War II didn't have much of an impact on the market. It's the internal feedbacks between the different time horizons of different speculative traders trying out different strategies. And this, you would have seen the work on the idea of zero intelligence traders, some of the work coming out of econophysics, and the same sort of thing. You're trying to get a model which emulates what the stock market actually does. And of course, when you look at it, what you get is a parallel distribution of market movements, not a Gaussian distribution. And again, all this stuff is saying this is how we explain the actual dynamics of the system, rather than the equilibrium and reacting to news nonsense that comes out of the efficient markets hypothesis.
Right. Well, there's the level of uncertainty tied to it as well. In those low volatility, low uncertain periods, the market tends not to pay attention to any outside news at all. That tends to be the case. But in the higher volatility, higher uncertainty periods, everything seems to affect the market in some way, at least in the near term. So because everybody's horizon is very short term. So as long as the market keeps reacting to near-term news, you can say that the long term is still not certain, and we're going to continue to have these periods of volatility going on. Whether that leads to a bear market or not is not clear, but we will have a state where those things can happen, because the high uncertainty periods are where you get those fat-tailed events. That's where you get the amplification, because everybody is on the same side of the market, and it's a matter of liquidity. That's one thing I forgot to mention about the hypothesis, is that the reason the market is exaggerated is that there's no liquidity on the opposite end. All the liquidity is on one side, so everybody wants to buy. That's where all the liquidity is, but you don't need it there.
Everybody wants to sell, which is the other extreme.
Which is the usual extreme. Actually, you don't get stampedes as often as you get the downturns.
But that turns up when you look at the size of stock market movements. You get both a power law distribution, and you also get big movements at one clustering of big movements and clustering of small movements. So if you look at, and this is one of the reasons the fractal markets hypothesis makes so much sense, because whether you look at the average return on the stock market, in terms of an increase in price or a decrease in price over time, is something trivial. It's like about, on a daily basis, 0.02%, that sort of movement. But the standard deviation is about 1%. Okay, so you get this tiny mean movement and huge standard deviation, and then people say, well, there can't be more than 5 standard deviations, so therefore the biggest market move you see is +5 or -5, and what you see instead is +20, that sort of thing coming out. But you also get periods where there's massive movements up and then massive movements down. And one of the intriguing things, if you read Fammer's original paper trying to champion the efficient markets hypothesis, I think back in '66, when he would have been trying to make his name at that stage, a young postgrad or a young PhD student trying to make his name. He said how the efficient markets hypothesis fitted the data really well from 56 to 76. He said, except that there were clustering of big movements that he couldn't explain. But fortunately, the big movements were both up and down, so they washed each other out.
Yeah. Okay.
So it seems to me that we've already made the point that the stock market tends to be forward-looking, right? And when we're looking historically back testing models and whatever, we're really looking in the rearview mirror rather than going forward. And we have the interaction going forward of fundamental uncertainty and expectation formation, right? Sort of what Keynes taught us. And it seems to me that it's one thing when you had human beings, traditional stockbrokers, buy, sell, and jostling with one another in the pits or at the New York Stock Exchange and what have you. But now more and more machines are trading with machines, and the machines trading are algorithms with algorithms, and more it's going to be AI algorithms trading with one another and the expectations of AI algorithms. And I'm wondering if Ed might speculate as to where this all might be headed in terms of the markets and the economy as the machines take over.
Well, it's not exactly clear, but one thing I often wonder about is,
Hasta la vista.
with cars that drive with AI make mistakes, right? Now, a lot of the mistakes that the cars make are the same mistakes we make as people. Okay, so if a machine is really an AI, if it's really trying to make a decision based on uncertain data, which is what we're doing, while I think it might make a decision faster, I'm not sure we can be completely sure that it's going to be the right decision. Okay, just because it's a machine doesn't mean it's going to know what's going to happen. The optimization problems, a lot of them, one of the problems with efficient markets, with Markowitz theory, is it assumes that there's a single hill you climb, and when you get to the top, that's the optimal solution, right? Where in real life, we're living in a multi-hilled fitness landscape, and we're not even sure we're on the highest peak So when we go up to the top, we don't know if that's the highest spot. And I don't see that. I don't see that AI, even when it's developed, will be any better at figuring that out than we are. Except it may come to a decision faster. That's the only thing you can see.
I remember talking to, there was a talk done by Hannah Fry. She's a BBC presenter, mathematician. She was talking about this sort of conundrum, I think, in terms of the emergence of AI to, for instance, help with traffic. So you have this situation where you've got, you're using Google Maps, and there's algorithms, and of course it tells you that this way's better. So, but everybody's seeing that data, so they all go there, and of course, then you've just created a different, log jam. So surely the AI, they're all trying to harvest the same information and just getting log jammed somewhere else, kind of thing. So surely, like I'm with Ed there. I just think, it's mimicking us, isn't it?
In addition to being able to make decisions faster, my thought on answering my own question is that in my experience building trading systems with students for like 15 years, is that the hardest thing for a person to do is follow their rules. So you devise a system, an entry rule to the market, long or short, a position sizing rule, here's how much I'm going to wager, if you will, and then an exit rule. Here's when I get out, either with a profit or a loss, hopefully a small loss or a profit such that it ain't going to give me any more, likely, so I'm out. And you back test it and you do all walk forward analysis, all that stuff, Monte Carlo experiments, and you say, hey, we're good to go. And as soon as the shooting starts with live ammo, you're not following the rules. So human beings have a very difficult time with this, following the rules of a scientifically based system. So I'm wondering if AI would be emotionless, quotation fingers, and not only make decisions faster, but at least follow the rules. I suppose the cars are doing that. I'm just spitballing here, but that would be my thought.
Well, that would be fine if the rules don't change. But if you change regimes, this is what I'm talking about. If you change regimes and you haven't trained the AI on this regime because it happened so long ago, or we don't have data to know what is going to happen, then the regime won't do any better than the rest of us. And that's it's like the thing about the correlation between stocks and bonds during high inflation, right? If you trained all of your trading models, asset allocation models based on data from 20 years ago, and to now, it wouldn't know how to react to this period of high inflation and what was going on. And that's the sort of thing that I'm really thinking about, is we're going to have novel situations. If an AI is really an AI, if it's really making decisions and it's trying to see things, make decisions under the kind of uncertainty that we do, then it's going to make the same kinds of mistakes that we do, because it's not going to see everything. It's not going to experience everything. Things will be slightly different each time. One thing that concerns me, though, is that when an AI makes the same mistake we do, we feel much worse about it. When a self-driving car makes the same mistake the rest of us do.
I see. We're more tolerant of humans stuffing up, but we don't tolerate the machines doing it. I see what you mean. Yeah.
That's it. I mean, there was one where it misjudged. It thought that a kid on a bike was a barrier or something, right? And a lot of us would make the same mistake. If you're not paying attention and you just see it out of the corner of your eye, you would make the same mistake. And AI made that mistake too, but who's responsible when that happens? When we make the mistake, we know who's responsible. We're responsible. But if the AI makes it, you can't sue the AI, right? So you sue the manufacturer, but it just made a mistake like a human did. Where's that going to go to? And that's something I've addressed.
Yeah, I don't think commercial lawyers are going to be out of a job anytime soon because of that. That's what I'm thinking. Unless they get an AI to be commercial lawyers as well, which I doubt.
Yeah, they can argue with one another. That should be interesting.
Yeah, so
when I use AI, I often find myself being polite to it. Could you please do the following? And then I'm like, why am I typing that extra stuff? It doesn't care. It's a machine.
Because it'll remember later when you'll be the one that it comes to and says, "Come with me if you want to live."
Yeah, when it becomes sentient, it'll remember who was kind to it. Yes.
Yeah. 100%.
As Tony's saying here, you'll come to me if you want to make money. So
those are your options.
Well,
do you have trading systems based on the fractal markets hypothesis, Ed? Or
no, I never got into a trading system in the way that you typically think of it. What I decided to do, and partially it was because of the limitations in the 90s when I was working on this. Right, computing power was much slower and all that, and so I decided to, and this is where my current work is also there. I decided to look at the different states the market goes into and what the kind of risk return trade-off you typically get in those states are, and set that as sort of the bar for what we're doing. Yeah. So if we're going into, the states I have are, there's a fragile state where the big downturns occur, a turbulent state where you have high volatility, but you don't have the up and downside tails are balanced. Okay. Then there's a transition state, and then there's a resilient state. And the resilient state, basically regular capital market theory does actually apply. Okay, and tail risks are actually smaller than normal. So if you know which state you're in, then you can apply the kind of investment strategy you want that would make money in that particular type of state. So that's the approach I've taken. And because my specialty was always asset allocation and multi-asset allocation, it was based on these particular approaches. And then other people in the firm would deal more with the trading models on what we should trade during those states.
So what state do you find the market in at the moment?
Well, at the moment, we're actually in a fragile state. Again, it's because indicators I have on non-financial leverage actually show that's actually high at the moment. But the volatility numbers, the uncertainty numbers are all falling pretty rapidly. The one that never got there was credit risk, which is a very common, very good indicator over time. And credit risk never became high in this environment. But the other uncertainty levels are falling, except interest rate risk, which is pointing towards more inflationary type growth, which could be a case. But it's very possible that things will, if those numbers, the implied volatilities in particular, which I look at, stay down at the levels they are now for a little more time, then we could go back to a resilient state for a while. But I think we're going to go into a period of fairly high uncertainty for an extended period. So it's probably a time when you would want something that is more risk neutral when you're investing. But at the moment, I'm still in the defensive mode because I think basically in the fragile state, what it says is that any type of bad news, it's like we said, any type of bad news can cause a downward movement in the markets. The negative tail is bigger than the positive tail, and that's where we stand at the moment. So that's how I use this. I know other people have come up with shorter term trading systems using things tied to this. I didn't have the computing power to use the Hurst exponent, which we talked about in long memory effect, as that changed because now there are more efficient algorithms for calculating the Hurst exponent, so you can have a local Hurst exponent as opposed to the global one that I was dealing with. So I know there are things going on out there. I've been watching them, but I myself don't use them. I've decided to stick with my regime and cycle states more than anything else.
Ty, can I bring you in here? Because I know you and Douglas have done a similar exercise just recently, and I've only seen Douglas's one actually, but it was looking at, now and the likely year and a bit ahead and modeling it. And I just wondered if you had the same, the modeling there was coming up with the same sorts of things that Ed's talking about with at least an impression, but you had more detailed modeling by the sounds of it.
Yeah. So the longer range, I know Doug really likes to use some of my long-term modeling, but we don't know what's going to happen through 2025 with Trump and, Ukraine and the Middle East. There's so many variables there. But right now, like in the 6 month term, we've got inflation 2 to 2.5% generally. In fact, the print's there's gonna be a rise here on the 13th, like in the latest print. And our modeling actually shows CPI going up in December as well, and then a slow decline into 2025. And that's all based basically off endogenous parts of my national model is dictating that, along with a few shocks. Some of the shocks that we're modeling right now is firm markups are still kind of persistent. So if you saw inflation through 2022, that was all supply. Like from our modeling, that was entirely created by a supply side shock, had nothing to do with fiscal policy. In fact, our modeling shows it reduced inflation on the other side because we had more capital investment. So as the economy was coming back on, there was actually more supply because of some of that fiscal stimulus. And then on the back half, what we saw through 2023 was persistent inflation as rates went up. Inflation stopped around 3% and then it just went sideways for a year. And Isabel Weber, like Steve was saying, has done a lot of great work in that area. And we're trying to actually endogenously model that. Right now, we're introducing the firm markup shocks, but we theorized that is probably what kept inflation persistent. One of the correlations that we suspect, we just haven't figured out how to model it, what kind of functions are, is that now, and Ed was saying this, markets evolve, the economy evolves, and there are different system states. So this might not necessarily always apply into the future or the past, but firms are actually offsetting their interest as rates went up. They just offset by marking up higher, right, and passed it on to the consumer. So that might be a function right there in the circumstance that we finally saw rates go up and accelerate at the fastest pace since the 1980s, that firms actually compensated by marking up. And that kept inflation persistent for longer. Now, ultimately, you get to a point where you can't mark up anymore, and the traditional effects of additional interest costs start slowing down growth, whether it's in the household sector, houses becoming, there's less buying and selling of houses, or in the firm sector where firms can't take out as much credit to invest in new capital to keep the economy going. Eventually something will break. Now, our narrative for 2025, we're thinking as a story, can the Fed stick the landing at 2%? So there's one variation of modeling where actually, because we saw such a extreme oscillation in 2022, anybody here, complex systems, if you introduce that shock, it's going to shock back down. Now, that's not entirely realistic, but that's a potential possibility. Another possibility is that the Fed just sticks tight to the rates where they're at now and decides no more cutting, although I don't believe they'll do that because Trump's in power now. And we just have this kind of the MMT perspective where CPI tends to where the policy rate is. And I don't necessarily subscribe to that, but that's another theory, right? So we just have this steady state inflation through 2025. So there's a lot of, Ed would know too, like if we're looking at this like a complex system, there's many different trajectories we can go. And the small initial conditions we are implementing in the model now, it could go a lot of different directions. But the model does say, 2026 of, Trump's got to deal with some sort of inflationary growth potentially. And then you've got the whole tariff thing. So tariffs could be considered inflationary, but at the same time, if there's big tax cuts for corporations, that just offsets the tax they're paying, right? And they don't pass anything off to the consumer. And if they do, it'd be rather minimal. Or tariffs could be really devastating because Americans are consumers and America doesn't produce the things it consumes, and the Americans will still want to consume those things, and they will pay a higher cost, and i.e. we have inflation. So it's a very broad. The more I do this, the more I understand not to make exact predictions, but to nuance everything, right? So there's a lot of possibilities, and Trump is a wild card. So there you go.
I was counting on your absolute crystal ball. That's well. Fine. I'll ask Ed then, because I want to know. No, exactly. It's always impossible, and anybody who's trying to predict the future, it's always a fool's errand. And yet, what choice do we have? We can't just fly blind every single day. Like, we have no idea. It's all chaos. So we're looking for patterns, right? So
yeah, one thing I wanted to reinforce about the states that I'm looking at is it's really about risk. Okay, risk and average return. Is this the kind of environment where you typically get a good risk return trade-off or not? And then you base your allocations on that, and that's a big part of it. So I think risk is a little easier to predict than return. In as far as the states go, and that part is, so that's why I focused on that rather than strictly forecasting returns, which I did spend a lot of my career trying to do.
And fruitfully, I mean,
yeah, it worked well, but it worked best when I coupled it with what kind of risk state we were in. That was first I put that endogenously into the models. The risk part was not sort of separate, but then I decided to change it so that you would look at how the process worked when the state was fragile versus when it was resilient, and you get different results.
Well, I've been trying to get exact predictions out of both of you. Obviously hasn't worked, which is completely unfair. So, Mike, I'm going to try Mike. And Mike, what are your? Come on, you must have some predictions that you can throw.
Come on, Mike. Exact predictions, Mike.
Of course there isn't, but I'm going to try.
For the stock market or for
everything, everything.
Just everything. No, but you've seen Ty and Ed at least have a stab at what's happening over the next bit, and you can throw your hat in the ring. Come on.
So inflation is really, with the recent election in the U.S., a big deal, right? Ty is talking about how they're looking at inflation in his macro model, how to represent it. Why is inflation occurring? I can tell you from my modeling, what we do is it's kind of a well-known set of structures and system dynamics that we use from time to time. There's people who have been in the field for a while are kind of have a mental inventory of these structures. So not starting always with a blank slate, and then you pick something to get you going. So in the matter of pricing, firm pricing, where the firms have some market power, which is a lot of them, it's the whole markup thing. And the structure that we tend to use originally comes from Seiert and March from Carnegie Mellon and their study of, I think it was grocery store pricing. I think that's what it was from memory. But at any rate, you start with the historical markup. So that's, what do we typically do around here? Managers will have that in mind. We typically mark it up 20% in this business, or 40%, or 5%, whatever differs by business. And then you have pressures that have you manipulate the markup, tune it up or tune it down. What might these pressures be? Well, some supply and demand considerations might be inventories. So relative to your desired or normal level of inventory that you carry, you got too much. You gotta get rid of it, particularly if it's a perishable. So what do? You have a sale to get rid of it. How do you get rid of it? You lower price. How do you do that? You lower the markup below the historical markup. Okay. Now that gets into a feedback loop, and then the historical slowly changes, right? So it's not a constant. Or on the other hand, we're out of alignment with our competitors' price. And you can put in some wiggle room. We're not selling cobs of corn here. The iPhone is a little bit different from the Android. The features are a bit different. So we can, or this model of car and that model of car, customers expect there to be a price difference, but if we get alignment, we got to correct that, and then you respond to your competitor's price, so on and so forth. So it's kind of a path-dependent process. You kind of get locked in to a particular markup and price level. So it's very hard to turn that around, and that the change in that gets you into inflation and all that. So think about it. Even if the rate of inflation is 0, all that means is we're not going up anymore. The prices aren't going down, right? So what do you do about that? Well, you don't want to cause a deflationary environment, because that can be another death spiral that's really bad. You got to boost wages, right? And so people can catch up and maybe accelerate. So now you get into the old ability to pay, ability to make pay models, right? It's one thing if labor can make the companies pay, either the labor market is tight or there's a union or whatever, but then they got to be able to pay. If they don't have it, they can't pay it. Right? So for labor to catch up, and there's productivity stuff going on there as well, and whatever. So it's a really complicated set of issues. The simplistic answers don't get you there, right? In terms of sort of predicting where things are going or what have you. But I think the Fed is getting inflation back down to, the classical 2% central bank target, pretty much around the world, not just in the US. But now the prices are still going to be going up. It's not 0. They're going to be just going up more slowly. And the wage rates, what are people going to be able to catch up, or are they going to continuously lose ground? This is one reason why Trump won across the board. I mean, people go into the store every day and say, my paycheck doesn't go as far, right? I mean, they could they could see that, they could feel it, and they were pissed off. So that's the key. I can tell you, as personally as a professor, we have never gotten raises any year ever that even matched inflation, let alone so I feel their pain as a professor.
Back to that question, we've got a question about the Federal Reserve right there, and it's hard to work out when somebody asks that question whether they think the Federal Reserve is the cause of all the ills of the system. But I know one thing which we're talking about inflation now. So I'm going to see if I can share my screen here. Pushing my luck, but I'll give it a go. Let's see. I've changed to a.
Here we go. Steve's about to break the internet.
No, it's going to work this time because I've got a decent connection. So can you see that one? Okay.
Yep.
Yeah.
Okay. That's okay. So what you look at that and you think, it's been price stability all the way out after the Fed gets formed, and then bang, we get this inflation. But what I've done deliberately, I've actually taken one wire out here. That's the index. Okay. What happens when you look at the rate of change? Okay, so this is now the period we're seeing here, which has all that terrible inflation. In actually the difference between the post-Federal Reserve system and the post-Second World War system and the pre is not that we have inflation now, we don't have deflation. Look at all these periods of really significant falls in prices. There's an annual rate of decline of prices of 25%. That's 28%. This happened to coincide with depressions, of course, but you get all this incredible up and down volatility. And actually, even though when you take a look at this range here, it looks like that's where inflation has occurred. No, it's where deflation hasn't occurred. That's the difference.
Yeah, the gold bugs will use the top sort of graph all the time, won't they? We'll look at price of oil since 1971. And you're like, yeah, do wages now.
I'm going to take this back and just take a look at them all. Yeah.
That's the thing too. You got to look at wage growth as well.
Yeah.
So.
This is the index. That's the CPI from 1661 until 1900, and basically it's ups and downs all the time. We haven't experienced that. What we've had instead, is this final bit over here, and we've just focused on the part after the inflation was driven out of the system. So you go to 38 forward, it's all been rising prices. But our fallacy is, prices were stable beforehand. No, they weren't. You didn't have deflation. That's the difference.
People don't understand what deflation means either. The regular person on the street, they have no idea.
Yeah.
One person said, "I want prices to go back to where they were in 1999." I said, "Well, you realize your wages and the value of your house are also going to go back to where they were in
And your
1999."
debt, they were not going to reduce your debt. And this is the issue. That's why deflation is so dangerous. It's normally tied with a level of private debt being extreme, and then deflation means your cash flow to service those debts disappeared, and bang, you're in a depression.
And it changes people's behavior.
Yeah.
So they say, I'm watching prices go down. I'm not going to buy now. It's going to be lower tomorrow or next week. So I'm going to hold off.
Mm-hmm.
And the other thing too is, going back to Trump is, he's talked about influencing what the Fed does. And I wrote a blog thing on this. It's not just Trump. It's politicians. The elected officials have a mechanism also for controlling inflation. They don't use it unless we have a crisis, right? They should be based on regular Keynesian economics, which may or may not always work, but based on the same thing, fiscal policy should be raised and lowered. You should, during good times, you should raise taxes and decrease spending, and then in bad times you decrease taxes and raise spending. They don't get that part of it. So if they don't know how to do that, how would they know what to do with interest rates?
Well, this is the danger I see of the Federal Reserve is that it's a bunch of neoclassical economists trying to run the economy as if it's one of their DSGE models. And that's the real problem. I mean, the crazy thing, Ed, I don't know how much you've kept up with the macro literature, but macroeconomics now, mainstream economics, blames volatility on volatility in consumption.
Oh.
Okay, this is what they call the Euler equation, and actually, Ty knows a fair bit about this as well. The models that they build, which are based on Ramsey's growth model, give the rate has the rate of change of the capital labor ratio, which they see reaching a stable point, and the rate of change of growth of consumer utility, which they want to see growing at a constant rate. They get a saddle out of that, a saddle node. Saddle obviously being unstable to a mathematician, but hey, we're talking economists here. So they said, well, what actually happens is consumption is a jump variable. So the only way you can reach this future bliss point, which the ultimate equilibrium you're trying to reach, is if you adjust your consumption now by looking forward to know what the consumption patterns are going to be through time. And so they see the trade cycle as being movements in people's consumption levels. And strangely enough, they haven't been able to find empirical verification for it.
Yeah.
To Ed's point, I think he's absolutely right. And I think the politicians, to the extent they listen to the economists, have been influenced by the rational expectations revolution. And what that did, it switched macroeconomics from being thought of as a way to control a complex system. And Ed, you were describing the traditional Keynesian using the national budget as part of a negative loop to stabilize the system. And it switched that from macroeconomics not being about that, but rather being about this chess game between the public sector and the private sector. And we're trying to outwit one another, taking into account all available information and predicting, what's going to happen in the future, and Ricardian equivalence and all that stuff. And to the extent that was bought into, you're right. They don't think about stabilizing an unstable system, which they could do with the federal budget. Yeah.
So you can't get rid of the Fed for a simple reason. You need a clearinghouse. And this is what's forgotten by most of the mainstream analysis, that you have to have a way that banks can settle their accounts with each other. And so that's the fundamental technical role of the Fed, is to be enabling reserve settlements to occur. But what they've got because economists get in control of it, a bunch of neoclassicals think they can manipulate the system using the interest rate. And now we've had, 40 years of that dominance, and serves them bloody right. They got inflation at the end there. That's what they're doing to supposedly control the rate of inflation is actually, as Mosler says, stimulating the financial sector by extra income. As Mosler didn't say, damaging the value of the assets, because any bonds that are mark to market are going to fall. So you get all this crazy manipulation between mark to market and hold to maturity. That nonsense. And inflation it's irrelevant. Inflation got kicked out of the system by a drop in growth of markups and the supply chain restabilizing after COVID. It's just a question when the next destabilization occurs. So they're controlling a model. They're not controlling the real world, and that's the danger, because they are. It does give them a license to manipulate the real world, which they don't understand.
Well, they should have paid attention. At the Chicago Fed, they actually break core inflation, what they call core inflation, into cyclical and acyclical components, and also put in the healthcare part. And the cyclical components are, of course, the things that would be affected by monetary policy, and the acyclical are not. And when you look at that through the whole COVID thing, the big run-up was in the acyclical components, and the big drop in inflation has, again, been in the acyclical components. The cyclical components have hardly changed. They've changed a little. They went up a little. Now they've come down a little. But it just means that monetary policy, as Mike said, has had very little, or Ty said, had very little impact on what's actually going on. It's all been the supply chains correcting themselves. And all that just gets ignored, and the public is now ingrained in this idea from, the idea from Milton Friedman that monetary policy is always, inflation is always about monetary policy, which of course is not necessarily the case, and it wasn't this time, but it got the blame.
So while we're modeling crazy shit like not having the Fed, let's have a look at the possibility of so this is what could happen with total control by the GOP, or the Trump administration, at least in January. You've got the possibility of a debt ceiling coming up, and they may use as leverage to implement some of the austerity plans they've got for the government, right? That would seem a logical possibility. What if they stuff it up and actually go into default, maybe not deliberately, but they over-egg the negotiations, which has nearly happened in the past? What happens under those scenarios where suddenly the liquidity just stops?
That probably won't happen because they're in control.
Okay, right. So it's used as a weapon.
Because last time when they controlled both houses of Congress, and when Trump was president, they just ignored the debt ceiling.
That's true.
So
it's only a weapon to use when they don't need to. They don't need to.
Yeah, exactly. Yeah. So I think that's one thing that'll probably go by the wayside. They don't worry about the debt when they're in charge. It's interesting. They only complain about it when they're not in charge.
Yeah, that'll be interesting to see, actually, because there's been such a big thing about it this time with Musk and the whole, here's how I'm going to shave $2 trillion off. Does he mean $2 trillion a year or $2 trillion over 10 years? No one knows.
$2 trillion a year.
Yeah. So
the funny thing in the U.S. right now, there's only about 1.3 trillion in discretionary spending. So it's going to be really interesting to see how Musk actually pulls that off.
One little backfire I can see happening with Musk is that if he goes down to slash government staffing the same way he went to slash Twitter staffing, a lot of the senior staff, anybody over 60, is going to say, I'm out of here. I've got my retirement package. I can do without the stress. I'm going to retire on the spot. And you're going to have a sudden loss of what expertise is left. I don't think there's a great deal anymore in the American bureaucracy, but there's quite a possibility a lot of the senior staff will disappear. Then you'll get junior staff being rapidly promoted to positions which they don't have the requisite experience, and all chaos breaking loose in government spending. And of course, the big one is that if you do try to cut that much government spending, you didn't cut GDP by more. So you then get caught in the downward spiral. So that's why I wrote my little, advice to Elon Musk about how when you know the financial system you're actually in, and it's not the one you get taught in your economics textbook, doing what you're going to do will cause a slowdown in the rate of growth and a slump and possibly a recession. So good luck with the next 2 years in terms of how the economy operates. But I think Musk will do it. I think he'll go in with the same attitude to government spending that he went into with Twitter, and that could it could be. I think wherever way it goes, we're in for exciting times in the next certainly 2 years.
I mean, on the surface, it sounds good. Efficiency drive, right? Like, who would be against that? But there's a lot of things that are inefficient for good reason. Take the entire education setup. It's deeply inefficient. There's a lot of people learning how to learn, and there's no way to just go automatically, here's how to make people learn faster or do, as an example of where inefficiency is okay. You want people to meander through, and it costs money. So
Well, I think, I think a lot of people like Trump and Musk, who are business people, don't seem to understand that there are crucial services which can't be run at a profit. Okay.
yeah, lots of them.
We've already seen it. The obvious one, of course, is the military. You can't run the military at a profit. You know,
Maybe.
no, I don't think so. Yeah, not an efficient military.
If the bill's being paid by things that aren't being factored in, then maybe. But
Yeah.
Well, they tried to run TSA. They tried to farm that out, and it was a disaster. Right? They tried to bring in people from the outside to do that, who were trying to run a profitable business doing it. It didn't work. And even Hayek said that any crucial service that should be that can't be run profitably should be run by the government. And one of the things he said along those lines was healthcare. Healthcare is also one of those things. We've shown in the United States that it can't be run profitably or efficiently because we can't make choices.
Not profitably and affordably at the same time.
Yeah, exactly. Because people can't make decisions, especially when it comes to their own health, and it's very difficult. So it's
one of Hayek's lesser known quotes. I think I certainly haven't heard it before. So yeah, that's interesting. I wonder why that's not put out more.
Yeah, I know what I'm going to be posting on Twitter later.
Yeah.
Hayek.
I've got one good question I want to just before White and Sunny out here. Any thoughts on fractals and macro and micro, or fractals and energy? And that's actually a very good observation, because everything in neoclassical theory points towards equilibrium, including their theory of the firm, and how profit maximization, you quote marginal cost and marginal revenue, reach equilibrium. And what we've done recently is show that the real profit maximization situation is constant variable cost per unit, constant price. So you get the rate of change of profit is price minus variable cost, which is positive. So you want to flog as many units as you can. And what you get out of that is the way you compete is by trying to take market share away from your rivals. So you're forever trying to innovate and bring out a product which your rivals can't compete with. So price is pretty much irrelevant. It's qualitative competition. And that evolutionary process will give you fractal behavior, both at the micro level and the macro level. So yeah, the fractality is something. You remember the old, I think it was Bertrand Russell giving a talk at some stage to some group of people in London, and a woman said, "Actually, you got it all wrong, Bertrand. The world sits on top of a turtle." And he says, "Well, who sits below the turtle?" He says, "Oh, you've got it wrong. It's turtles all the way down." Now, what you get in the real world, it's fractals all the way down. So fractal behavior at the micro level, we get fractal behavior in the dynamics at the macro level. And that's like, I've got to take my hat off to Ed, because your work was a major contribution to how I thought about the finance sector and how I taught my students at the time. So, I would love to actually be more prepared next time. I come and give a bit of a tutorial about fractals and Hertz exponents and box measures and so on. And that's, you think you made a major contribution, mate. You should not be the one. It shouldn't be fucking Fama and Sharp and Mob got the Nobel Prize. If there was a real world, you should have got it for your work on the finance markets.
Oh, thank you very much.
And as a special honorary, thank you for your work you've done. You can do top chatters, Ed. So there's no great honor.
I wasn't gonna say anything, but
yeah. I mean, some people get Nobel prizes, but you get top chatters today.
There you go.
Well, so you want me to read off this
list? As fast as you possibly can is the accepted way. Okay.
Dreg-Eye, Tony Wilson, Ghost on the Half Shell, Maud Ibrahim Hussein, Phil Waller, Douglas Dowell, JD, Al Zeroism, Cherry Wise, The Herald of Change, Blue Bay, Go Mater with Ollie Sharp, Joe Polito, Paul Ryan, BSC, Sean Domratkowski, Reagan Boychuk, Long Defiant, Gavin Van, Stakopoulos, X, they should all be that short, Mangala Raj, TR, Lana Dell Hates the Clock, Sonic, yeah. Michael D'Souza Cruz, Thomas Darlington, Big Hammer, Life 42, The Universe, Larry Summers, Shot, Jupiter, The Hasty Ent, John Watson, Spoonicle, Lone Candle, Christopher Dobby, Web Freaks, Prashant Kamath, David Collins, Bill Goggin, Cabin Economics, George Robertson, John Troughton, Bruce Considine, Benjamin Wall. That was that.
Class.
That was good. That was good.
That was good.
Made it through good. Yeah.
Yeah.
Ed, is there an easy way for people who want to know more to get in touch with you, or there's a website I know, so maybe just drag me, or whatever you think is the best way to people just find you. Maybe it's just Google Ed E Peters or something like that.
Yeah, well, my website is edgarepeters.com. Okay, so it's easy to remember. I'm also on LinkedIn, so you can also get me there. Just Google me there. Usually, if you Google Edgar E Peters, I'll pop up, so that'll also happen as well. Okay, thank you very much. This has been a lot of fun.
The website's in the description, everybody, on all the feeds. So if you just need to click on the description and you'll find them in there.
Thank you
It'd be
again.
nice if everybody read my books, but like I said, they're available used. I would go that way.
Thank you again, Ed. And everybody else out there listening, thank you very much for listening and being here with us live. For now, take care, be nice, hit subscribe and the bell so you know when we're on next time. Look after yourself. Remember to brush your teeth, visit your mum and hit subscribe, like I said, twice. And then you'll know when we're going live next week. But it's a goodbye from Steve Keen and friends, and we'll see you next time.